School of Management Studies IGNOU presents an audiobook on the course MMPC 004 Accounting for Managers for MBA program. Block 3 Application of Cost Accounting, Unit 10 Budgeting and Budgetary Control, Part 1.
After completing this unit, you should be able to understand the basic aspects of financial planning and the role of budgeting, various types of budgets, and some new ideas and development in the area of budgeting. Introduction. At the beginning of the course, we have emphasized the need for managers to be forward-looking. For you, therefore, reviewing the past information alone is not enough, since your job involves predicting and shaping the future of your enterprises. This requires proper planning about all activities of the business. Finance being the lifeblood of a business, financial planning is of utmost significance to a businessman. Therefore, a budget is an essential tool for financial planning and control. However, before we come into the intricacies of budgeting, it will be useful for us to understand the meaning and implications of financial planning. Financial planning. Financial planning is concerned with the raising of funds and their effective utilization to maximize the company's wealth. It includes the determination of number 1, the amount of funds needed for implementing various business plans. Number 2, the pattern of financing, that is, the form and proportion of various corporate securities such as shares, debentures, bonds, bank loans to be issued or raised. And number 3, the timing of flotation of various corporate securities. Despite a sound financial plan, the desired results may not be achieved if there is no effective control to ensure its implementation. The budget represents a set of yardsticks or guidelines for use in controlling an organization's internal operations. The management through budget can evaluate the performance of every level of the organization. The discrepancy between planned performance and actual performance is highlighted through budgets. The organization may have to change the course of its operations in a particular area or revise its plans keeping in view the changing conditions. It will therefore be useful for you to understand the complete budgeting process. In this unit, we shall explain what budget is and what budgetary control means. Besides the importance of budgeting as a management tool, the techniques of preparing various types of budgets will also be discussed. What is a budget? A budget is a plan expressed in quantitative, usually monetary terms, covering a specific period of time, usually 1 year. In other words, a budget is a systematic plan for the utilization of workforce and material resources. In a business organization, a budget represents an estimate of future cost and revenues. Budgets may be divided into two basic classes: capital budgets and operating budgets. Capital budgets are directed towards proposed expenditures for new projects and often require special financing. The operating budgets are directed towards achieving short-term operational goals of the organization, for instance, production or profit goals in a business firm. Operating budgets may be subdivided into various departmental or functional budgets. The main characteristics of a budget are: number 1, it is prepared in advance and is derived from the long-term strategy of the organization. Number 2, it relates to the future period for which objectives or goals have already been laid down. And number 3, it is expressed in quantitative form, physical or monetary units, or both. Different types of budgets are prepared for different purposes. For example, sales budget, production budget, administrative expense budgets, raw material budget, etc. All these sectional budgets are afterwards integrated into a master budget that represents the organization's overall plan. A budget is useful in many ways, like number 1, it brings about efficiency and improvement in the working of the organization. Number 2, it is a way of communicating the plans to various units of the organization. By establishing the divisional, departmental, sectional budgets, exact responsibilities are assigned. It thus minimizes the possibilities of buck passing if the budget figures are not met. Number 3, it is a way of motivating managers to achieve the goals set for the units. Number 4, it serves as a benchmark for controlling ongoing operations. Number 5, it helps in developing a team spirit where participation in budgeting is encouraged. Number 6, it helps in reducing wastage and losses by revealing them in time for corrective action. Number 7, it serves as a basis for evaluating the performance of managers. And number 8, it serves as a means of educating the managers. Budgetary control. No system of planning can be successful without having an effective and efficient system of control. Budgeting is closely connected with control. The exercise of control in the organization with the help of budgets is known as budgetary control. The process of budgetary control includes number 1, preparation of various budgets, number 2, continuous comparison of actual performance with budgetary performance, and number 3, revision of budgets in the light of changed circumstances. A system of budgetary control should not become rigid. There should be enough scope for flexibility to provide for individual initiative and drive. Budgetary control is an important device for making the organization more efficient on all fronts. It is an essential tool for controlling cost and achieving the overall objectives. Installing a budgetary control system. Having understood the meaning and significance of budgetary control in an organization, it will be useful to know how a budgetary control system can be installed. This requires, first of all, finding answers to certain questions in the context of an organization. Number 1, what is likely to happen? Number 2, what can be made to happen? Number 3, what are the objectives to be achieved? Number 4, what are the constraints and to what extent their effects can be minimized? Having found answers to all these questions, certain steps may be taken to install an effective budgetary control system in an organization. Number 1, organization for budgeting. Setting up a definite plan of organization is the first step towards installing a budgetary control system in an organization. A budget manual should be prepared giving details of the powers, duties, responsibilities, and areas of operation of each executive in the organization. Number 2, responsibility for budgeting. The responsibility for preparation and implementation of the budgets may be fixed as budget controller. Although the chief executive is finally responsible for the budget program, it is better to delegate a large part of the supervisory responsibility to an official designated as budget controller or budget director. Such a person should have knowledge of the technical details of the business and should report directly to the president or the chief executive of the organization. Budget committee. The budget controller is assisted in his work by the budget committee. The committee may consist of heads of various departments, viz. Production, sales, finance, personnel, purchase, etc., with the budget controller as its chairman. It is generally the responsibility of the budget committee to submit, discuss, and finally approve the budget figures. Each head of the department should have his own subcommittee with executives working under him as its members. Fixation of the budget period. Budget period means the period for which a budget is prepared and employed. The budget period depends upon the nature of the business and the control techniques. For example, a seasonal industry will budget for each season, while an industry requiring long periods to complete work will budget for 4, 5, or even larger number of years. However, control purposes must prepare budgets both for long as well as short periods. Budget procedures. After establishing the budget organization and fixing the budget period, the actual work or budgetary control can be taken upon the set pattern. Key factor. It is also termed as limiting factor. The extent of influence of this factor must first be assessed in order to ensure that the budget targets are met. It would be desirable first to prepare the budget relating to this particular factor and then prepare the other budgets. The key factors should be correctly identified and examined. The key factors need not be of a permanent nature. In the long run, the management may overcome the key factors by introducing new products, changing material mix, working overtime, or extra shifts, etc. Making a forecast. A forecast is an estimate of the future financial conditions or operating results. Any estimation is based on the consideration of probabilities. An estimate differs from a budget in that the latter embodies an operating plan of an organization. A budget envisages a commitment to certain objectives or targets which the management seeks to attain on the basis of the forecast prepared. A forecast, on the other hand, is an estimate based on the probabilities of an event. A forecast may be prepared in financial or physical terms for sales, production cost, or other resources required for business. Instead of just one forecast, a number of alternative forecasts may be considered to obtain the most realistic overall plan. Preparing budgets. After the forecasts have been finalized, the preparation of budgets follows. The budget activity starts with the preparation of the sales budget. Then production budget is prepared based on the sales budget and the production capacity available. The financial budget, that is cash or working capital budget, will be prepared on the basis of sales forecast and production budget. All these budgets are combined and coordinated into a master budget. The budgets may be revised in the course of the financial period if it becomes necessary to do so in view of the unexpected developments which have already taken place or are likely to take place. Choice between fixed and flexible budgets. A budget may be fixed or flexible. A fixed budget is based on a fixed volume of activity. It may lose its effectiveness in planning and controlling if the actual capacity utilization is different from what was planned for any particular unit or time, for example, a month or a quarter. The flexible budget is more useful for changing levels of activity as it considers fixed and variable costs separately. Fixed costs, as you are aware, remain unchanged over a certain range of output. Such costs change when there is a change in capacity level. The variable costs change in direct proportion to output. If flexible budgeting approach is adopted, the budget controller can analyze the variance between actual cost and budgeted cost, depending upon the actual level of activity attained during a period of time. Classification of budgets. Budgets can be classified into different categories on the basis of time, function, or flexibility. The different budgets covered under each category are: number 1, rolling budget. Some organizations follow the practice of preparing a rolling or progressive budget. In such organizations, a budget for a year in advance will always be there immediately after a month or a quarter passes. As the case may be, a new budget is prepared for 12 months. The figures for the month or quarter which have rolled down are dropped, and the next month or quarter figures are added. For example, suppose a budget has been prepared for the year 2020 after the expiry of the first quarter ending 31st March 2020. A new budget for the full year ending 31st March will be there. In that case, 2021 will be prepared by dropping the figures for the quarter which has rolled, that is quarter ending 31st March 2020, and adding the figures for the new quarter ending 31st March 2021. The figures for the remaining 3 quarters ending 31st December 2020 may also be revised if necessary. This process will continue whenever a quarter ends and a new quarter begins. Sales budget. Sales budget generally forms the fundamental basis on which all other budgets are built. The budget is based on projected sales to be achieved in a budget period. The sales manager is directly responsible for the preparation and execution of this budget. He usually takes into consideration certain organizational and environmental factors while preparing the sales budget. It is desirable to He usually takes into consideration certain organizational factors like plant capacity, orders on hand, cost of distribution of goods, etc., and environmental factors like government controls, rules and regulations relating to the industry, political situation and its impact on the market, etc., while preparing the sales budget. It is desirable to break up the entire sales budget on the basis of different products, time periods, and sales areas or territories. Production budget. This budget provides an estimate of the total volume of production distributed product-wise with the scheduling of operations by days, weeks, and months, and a forecast of the inventory of finished products. Generally, the production budget is based on the sales budget. The responsibility for the overall production budget lies with the works manager, and that of departmental production budgets with departmental works managers. Production budget may be expressed in physical or financial terms or both in relation to production. The production budgets attempt to answer certain questions like what is to be produced, when it is to be produced, and how it is to be produced, along with where it is to be produced. The production budget envisages the production program for achieving the sales target. It serves as a basis for preparing related cost budgets, for example, materials cost budget, labor cost budget, etc. It also facilitates the preparation of a cash budget. The production budget is prepared after taking into consideration several factors like inventory policies, sales requirements, production stability, plant capacity, availability of materials and labor, and time taken in the production process, etc. Production cost budgets. There are 3 elements of cost, namely direct material, direct labor, and overheads. Separate budgets for each of these elements have to be prepared. The direct materials budget has 2 components. Number 1, materials requirement budget, and number 2, materials procurement or purchase budget. The former deals with the total quantity of materials required during the budget period, while the latter deals with the materials to be acquired from the market during the budget period. Materials to be acquired are estimated after considering the closing and the opening inventories and the materials for which orders have already been placed. Direct labor budget. Direct labor budget, like direct materials budget, may be divided into 2 categories. Number 1, direct labor requirement budget, and number 2, direct labor procurement budget. The former deals with the total direct labor requirement in terms of quantity or and value, while the latter states the additional direct workers to be recruited. Overhead budget. The overheads may relate to the factory, general administration, selling and distribution function, etc. Therefore, separate budgets may be prepared for factory overheads, administrative overheads, and selling and distribution overheads. Factory overheads budget. Factory or manufacturing overheads include the cost of indirect material, indirect labor, and indirect expenses. Manufacturing overheads may be classified into number 1, the volume of output, number 2, variable overheads, that is, which tend to vary with the output, and number 3, semi-variable overheads, that is, which are partly variable and partly fixed. The manufacturing overheads budget will provide an estimate of these overheads to be incurred during the budget period. Fixed manufacturing overheads can be estimated based on past information and knowledge of any changes which may occur during the ensuing budget period. Variable overheads are estimated after considering the scheduled production and operating conditions in the budget period. Administrative overheads budget. This budget covers the administrative expenses, including the salaries of administrative and managerial staff. A careful analysis of the needs of all administrative departments of the enterprise is necessary. The minimum requirements for the efficient operation of each department can be estimated on the basis of cost for the previous years and after a study of the plans and responsibilities of each administrative department for the budget period. The budget for the entire administrative function is obtained by integrating the separate budgets of all administrative departments. Selling and distribution overheads budget. This budget includes all expenses relating to selling, advertising, delivery of goods to customers, etc. It is better to analyze such costs according to products, types of customers, territories, and the sales departments. The responsibility for the preparation of this budget rests with the executives of the sales department. There must be a relationship of selling expenses with the volume of sales expected, and an effort should be made to control the cost of distribution. The preparation of the budget would depend on analysis of the market situation by the management, advertising policies, research programmers, and the fixed and variable elements. Cash budget. Planning cash and controlling its uses are essential tasks. If the future cash flows are not properly anticipated, it is likely that idle cash balances may be created, resulting in unnecessary losses. It may also result in cash deficits and consequent problems. The financial manager should therefore plan the needs and uses. Budget is a useful device for this purpose. The cash budget is a summary of the firm's expected cash inflows and outflows over a particular period of time. In other words, cash budget involves a projection of future cash receipts and cash disbursements over various time intervals. A cash budget helps the management in number 1, determining the future cash needs of the firm, number 2, planning for financing of those needs, and number 3, exercising control over cash and liquidity of the firm. The overall objective of a cash budget is to enable the firm to meet all its commitments in time and at the same time prevent accumulation at any time of unnecessary large cash balances with it. There are two types of flows in both these components, viz. Operating cash flows and financial cash flows. Some common elements of each are cash inflows operating. They include cash sales, receivable collections. Cash inflows financial. They include interest receipts, sale of marketable securities, and issue of new securities. Cash outflow operating. They include wage payments, payments of bills and accounts payable, and capital expenditure payable. Cash outflow financial. They include dividend payments, interest payments, redemption of securities, loan repayments, purchase of marketable securities, and tax payments. Sales worksheet. Sales bring in a major part of cash inflows. All sales may not be against cash. Credit sales are also pretty common. Each business establishment has its own credit policy for promoting sales. Even when care is taken to ensure that credit sales do not exceed the permitted percentage of total sales and that debtors do not default in paying bills in time, it is a common experience that the total amount of sales is recovered over a period of time. Master budget. The master or final budget is a summary budget which incorporates all functional budgets in a capsule form. It sets out the plan of operations for all departments in considerable detail for the budget period. The budget may take the form of a profit and loss account and a balance sheet as at the end of the budget period. The master budget requires the approval of the budget committee before it is put into operation. Sometimes, a number of master budgets may have to be prepared before the final one is agreed upon. The budget generally contains details regarding net sales, production cost, cash position, and key account balances like debtors, fixed assets, bills payable, etc. It also shows the gross and net profits and the important accounting ratios. Fixed and flexible budgets. Fixed budget. A fixed budget is designed to remain unchanged irrespective of the level of activity. This budget is prepared on the basis of a standard or fixed level of activity. Since the budget does not change with the change of level of activity, it becomes an unrealistic yardstick in case the level of activity, like volume of production or sales actually attained, does not conform to the one assumed for budgeting purposes. The management will not be able to assess the performance of different heads on the basis of budgets prepared by them because they can serve as yardsticks only when the actual level of activity corresponds to the budgeted level of activity. On account of the limitations of fixed budgeting and its inability to provide for automatic adjustments when the volume changes, firms whose sales and production cannot be accurately estimated have given up the practice of fixed budgeting. Flexible budget. The flexible budget is designed to change in accordance with the level of activity attained. Thus, when a budget is prepared in such a manner that the budgeted cost for any level of activity is available, it is termed as flexible budget. Such a budget is prepared after considering the fixed and variable elements of cost and the changes that may be expected for each item at various levels of operations. Flexible budgeting is desirable in cases where: Number 1. Because of the nature of business, sales are unpredictable, for example in luxury or semi-luxury trades. Number 2. The venture is new and therefore it is difficult to foresee the demand, for example novelties and fashion products. Number 3. Business is subjected to the vagaries of nature such as soft drinks. And number 4. Progress depends on an adequate supply of labor and the business is in an area suffering from a shortage of labor.
We were listening to the audiobook by the School of Management Studies IGNOU for MBA program course code MMPC 004 Accounting for Managers. Course Coordinator Professor Kamal Bagrecha, School of Management Studies IGNOU. Voiceover by Harpreet Kaur. Edited by Ashok Sharma. Program assisted by Tarannum Jahan and Jagbandhu Jana. Program produced by Dr. Manoj Kumar Singh. This program was brought to you by Electronic Media Production Center of Indira Gandhi National Open University.